Hey traders, welcome back to Discount Trader. In today's breakdown, we're going to study a beautiful smart money concept sequence on the 1-hour time frame. I'll walk you through every step in the exact order I marked on the chart, starting with the liquidity sweep, moving into the point of interest, break of structure, inducement, the order block, the sell-side liquidity target, and finally, the clean sell entry that completes the setup. By the end of this video, you'll understand not just where I entered, but why each step confirms the next. Let's get started. The first thing I marked is the liquidity sweep. On the chart, you'll notice price had formed a set of highs that were obvious to retail traders. These highs attract stop losses, buy stops, and breakout traders who are expecting price to continue upward. But smart money uses these areas as fuel. Watch how price pushes above those highs, not to continue trending, but simply to grab that liquidity. You'll see a quick wick or rejection right after the sweep. This is important because a liquidity sweep is the market's way of saying, okay, we've collected the orders we needed, now we can move the other way. This gives us the first clue that a potential reversal or bearish move is coming. Once the liquidity sweep is complete, the next thing I marked is the point of interest, or POI. This is the larger zone on the chart, a key area where institutions previously placed their significant buy or sell orders. In this case, after sweeping liquidity, price retraces back into this POI. Why is this important? Because a POI is where we often expect the market to rebalance, test institutional footprints, and prepare the next leg. I always tell traders, a liquidity sweep tells you a reversal may come, but the POI tells you where the reversal will likely start. Next, I marked the break of structure, or BOS. This step is crucial because it confirms the change in market direction. Before the sweep, the structure was bullish, higher highs, higher lows. But after the sweep, watch how price aggressively breaks below the previous structural low. That clean break gives us the bearish confirmation we need. Break of structure isn't just a line on the chart, it's proof that the market has shifted from accumulation to distribution. Once we have a break of structure on the 1-hour time frame, we officially expect the market to move downward and deliver into lower liquidity. Fourth in the sequence is inducement. Inducement is one of the most misunderstood concepts, but it's extremely powerful. It refers to the small liquidity pool that forms before price taps into the point of interest or order block. Look at the chart. You'll see a small high created just before price reaches our point of interest. This small high tempts early sellers to enter too soon. Their stop losses become liquidity. Smart money deliberately creates inducement because it gives them extra liquidity to fill their institutional orders. It ensures retail gets trapped on the wrong side. It increases the probability that the point of interest will hold perfectly. When inducement gets taken out, that's when you know the real move is coming. Fifth, I marked the order block, which sits inside the point of interest. This is the exact zone where institutions placed their last buy orders before the bearish displacement. On the chart, it's that final bullish candle before the strong drop. That candle is not random. It represents institutional positioning. We refine our entry by using the order block instead of the whole point of interest. This gives us a tighter stop loss, a stronger entry, a cleaner risk to reward. More precision. When price returns to the order block, rejects it, and leaves displacement candles, that's our signal to prepare the entry. Next in the sequence is the target, sell-side liquidity. Look at the lows marked on the chart, equal lows resting beneath the structure. These levels hold sell stops from retail buyers and breakout traders. Institutions want those stops. So once we have a break of structure and price taps the order block, the next logical destination is this sell-side liquidity zone. This becomes our take-profit area. We're not trading blindly. We're trading toward liquidity. And finally, step 7. The sell entry. Here's the full logic. Liquidity gets swept. Price returns to point of interest. Break of structure gives bearish confirmation. Inducement gets taken. Order block gets respected. Sell-side liquidity becomes the target. So when price taps the order block and rejects, that's our entry. Stop loss goes just above the order block high. Take profit goes at the sell-side liquidity zone. This creates a clean, structured, high-probability SMC sell setup. This is how you trade with smart money, not against it. And that completes the full breakdown of this 1-hour smart money concept sequence. If you want more detailed SMC videos like this, make sure to subscribe to Discount Trader. Drop a comment if you want me to break down more entries or create short versions of this setup. Thanks for watching. Trade safe, and I'll see you in the next video.